If you have a capital gain of any size here in Canada, there's a simple way of paying $0 of tax on that gain, legally. Now, CRA doesn't typically allow you to avoid large tax bills, but this strategy not only allows you to avoid the tax bill, but you'll get a tax credit along the way. So it's actually a double tax benefit, and something that could save you thousands to tens of thousands of dollars on your tax bill in the next few years. Before we jump into it, if you haven't already subscribed to the channel, make sure to hit the subscribe button. Join the channel. We release 2 brand new videos every single week around tax, estate, and financial planning for Canadians. So in this example, I'm going to use a bigger number. I'll use a smaller number example after this, but bigger numbers seem to get the point across more. But this concept works with any amount of dollars that you have. So let's say you have a non-registered investment account. And this is where it's really important. You have to have a capital gain on an investment. So not an RSP, not a tax-free savings account, but a non-registered account, or a margin account, a lot of firms call it. So let's say you have a non-registered account. You bought a stock in there and it had a nice gain. So let's say you paid $50,000 for it and it's ran up over the years to $100,000. Let's say it was Tesla stock. Paid $50,000 for Tesla stock, now it's $100,000. I've talked to many of you that are in this position, sometimes even larger numbers. So you have $100,000 sitting in that account, but if you sold your Tesla stock, you're going to pay tax on the gain. So the gain is going to be $50,000, and in Canada, capital gains tax is 50% of that, meaning that $25,000 of that, if you were to sell the full $100,000, is going to be taxable to you. Now that $25,000 is going to be added to your income, meaning that if you make $100,000 already, now you made $125,000, meaning that that $25,000 is going to be taxed at your marginal tax rate. The marginal tax rate, again, I've covered this in a recent video, is how much tax do I pay on the next dollar that I earn? So in this case, capital gains is taxed on top of your other income that you have. So let's say you fall into, on average, a 30% marginal tax rate. So the next dollar that you earn is going to be 30% tax. So that $25,000 at 30% tax, you're going to be about $7,500 in taxes due. So if you sold your investment, you have that $50,000 gain, you only pay $7,500 in tax, but it's still $7,500 in tax. That's a lot of money out of your pocket because you made a good investment. Like, it kind of sucks that we have to pay that amount of tax because you did well on your investments. Because when you lose on your investments, yeah, you can use your capital gains going forward, but it's not like you get reimbursed from CRA. So again, $7,500 of your hard-earned investment money out the door to taxes. So what are the ways around not paying that tax? One of the best ways to do that is to donate the shares. So here's the double tax benefit, and then I'll break down the numbers. When you donate shares in kind, if there's a capital gain on those shares or unrealized capital gain on those shares, you never pay the tax. Those gains are never realized. Meaning that in the situation that I talked about, the $100,000, we could donate that $100,000 to a registered charity. We will get a $100,000 donation receipt, which we'll use as a credit, and we'll get a lot of that money back through taxes. But the gain, that $50,000 gain, we never pay it. We never trigger it. We never capitalize on it. We don't ever pay that tax. And guess what? The charity doesn't either. The charity receives that $100,000 donation with a $100,000 cost base, and your $50,000 cost base, it goes away. You've made your $100,000 donation. So we've avoided the $7,500 to pay to CRA, and guess what? You have a donation receipt worth $100,000. Depends which province or territory you're in, you're gonna get about $43,000 back on your taxes. Maybe a little bit more, maybe a little bit less, that's kind of the average, $43,000. So sure, you're sitting there saying, Adam, but I had $100,000, even if I pay $7,500 in taxes, I'm still left with over $90,000 in my pocket, whereas this scenario, I'm only left with like $43,000. Like, this isn't better. Here's the kicker. A lot of you do donate, and I appreciate that, and the charities that you're giving to, trust me, they appreciate it. There's a lot of great charities that need support in our country and across the world, both locally and globally. So if you're someone that wants to donate, has the heart to give, consider giving shares in kind. If you have shares sitting in a non-registered account, with a gain, with any type of gain. Maybe substantial, maybe it's just a small gain. But you can donate those shares and avoid the tax altogether. Now, why is it important to avoid the tax? Remember, that $25,000 of income is income to you. Maybe you're in retirement. Adding $25,000 of income onto the rest of your income that you already have might trigger an OAS clawback. So not only are you paying $7,500 in taxes, but you might be losing another $7,500 in OAS or $3,000 or any number. But it's a loss of income to you. Now we could take that same scenario with $10,000, $1,000. The result is you're avoiding the taxes on the capital gains to CRA, and CRA is also giving you a donation credit that you can use towards your taxes to save on taxes to get more money back. So it's a double tax benefit. We don't see this very often with CRA because CRA is a tax collector. Typically, they're not very generous with giving taxes back to you unless they actually do owe it to you. So as you work through your tax planning, again, if you have a big gain on any type of investment, talk to your tax accountant, talk to your financial planner. Some of you are selling companies, and the way that it's structured, you might be able to donate some of those shares, even if they're private shares. You can donate those out, get the tax breaks, save a lot of taxes, right? There's different strategies here. But at the end of the day, we've done this for many clients. I've seen it done many times over. My dad actually worked in kind of as a fundraiser. So he worked in the other side of it where they don't collected donations a lot. And the wealthiest people in Canada that made donations typically made it through two ways. They made it through shares, so to avoid that capital gains tax, and they made it through proceeds of life insurance, because that's a very tax efficient way, and we'll cover that in a future video, but another tax efficient way to kind of shelter money and then multiply it and give it out and have more money than you would have otherwise, plus leave more for your estate. Those, again, multiple benefit there. So if you're someone sitting with capital gains, you're not sure how this works, reach out to our office. We're happy to walk you through this process, see if it makes sense for you. And again, it's not about who you're giving the money to. As long as it's a registered charity that obviously you care about and you want to help out, it's a great strategy for those looking to give and save on taxes.